Today, we will talk about investing in crypto for beginners. Cryptocurrencies have been enormously volatile since being introduced, but that volatility can create opportunities for profit if you're looking to trade these digital assets. Cryptos such as Bitcoin and Ethereum have risen a lot since their debut, but are down significantly from their highs along with other popular digital currencies. Experienced traders have been speculating on cryptocurrencies for years, but how can you get started if you're new to the crypto market? In the cryptocurrency landscape, securing one's assets is of utmost importance, and hardware wallets have emerged as one of the most secure means of safeguarding digital assets. Here's a deeper dive into the topic. 1. Understand what you're investing in. As you would for any investment, understand exactly what you're investing in. If you're buying stocks, it's important to read the annual report and other SEC filings to analyze the companies thoroughly. Plan to do the same with any cryptocurrencies, since there are literally thousands of them. They all function differently, and new ones are being created every day. You need to understand the investment case for each trade. In the case of many cryptocurrencies, they're backed by nothing at all, neither hard assets nor cash flow of an underlying entity. That's the case for Bitcoin, for example, where investors rely exclusively on someone paying more for the asset than they paid for it. In other words, unlike stock, where a company can grow its profits and drive returns for you that way, many crypto assets must rely on the market becoming more optimistic and bullish for you to profit. Some of the most popular coins include Ethereum, Dogecoin, Cardano, and XRP. So before investing, understand the potential upside and downside. If your financial investment is not backed by an asset or cash flow, it could end up being worth nothing. 2. Remember, the past is past. A mistake that many new investors make is looking at the past and extrapolating that to the future. Yes, Bitcoin used to be worth pennies, but now is worth much more. The key question, however, is will that growth continue into the future, even if it's not at quite that meteoric rate? Investors look to the future, not to what an asset has done in the past. What will drive future returns? Traders buying a cryptocurrency today need tomorrow's gains, not yesterday's. 3. Watch that volatility. The prices of cryptocurrencies are about as volatile as an asset can get. They could drop quickly in seconds on nothing more than a rumor that ends up proving baseless. That can be great for sophisticated investors who can execute trades rapidly, or who have a solid grasp on the market's fundamentals, how the market is trending, and where it could go. For new investors without these skills, or the high-powered algorithms that direct these trades, it's a minefield. Volatility is a game for high-powered Wall Street traders, each of whom is trying to outgun other deep-pocketed investors. A new investor can easily get crushed by the volatility. That's because volatility shakes out traders, especially beginners who get scared. Meanwhile, other traders may step in and buy on the cheap. In short, volatility can help sophisticated traders buy low and sell high, while inexperienced investors buy high and sell low. 4. Manage your risk. If you're trading any asset on a short-term basis, you need to manage your risk. And that can be especially true with volatile assets, such as cryptocurrency. So as a newer trader, you'll need to understand how best to manage risk and develop a process that helps you mitigate losses. And that process can vary from individual to individual. Risk management for a long-term investor might simply be never selling, regardless of the price. The long-term mentality allows the investor to stick with the position. Risk management for a short-term trader, however, might be setting strict rules on when to sell, such as when an investment has fallen 10%. The trader then strictly follows the rule so that a relatively small decline doesn't become a crushing loss later. Newer traders should consider setting aside a certain amount of trading money and then using only a portion of it, at least at first. If a position moves against them, they'll still have money in reserve to trade with later. The ultimate point is that you can't trade if you don't have any money. So keeping some money in reserve means you'll always have a bankroll to fund your trading. It's important to manage risk, but that will come at an emotional cost. Selling a losing position hurts, but doing so can help you avoid worse losses later. 5. Don't invest more than you can afford to lose. Finally, It's important to avoid putting money that you need into speculative assets. If you can't afford to lose it, all of it, you can't afford to put it into risky assets, such as cryptocurrency or other speculative assets, for that matter. Whether it's a down payment for a house or an important upcoming purchase, money that you need in the next few years should be kept in safe accounts so that it's there when you need it. And if you're looking for an absolutely sure return, your best option is to pay off debt. You're guaranteed to earn or save whatever interest rate you're paying on the debt. You can't lose there. Finally, don't overlook the security of any exchange or broker you're using. You may own the assets legally, but someone still has to secure them, and their security needs to be tight. If they don't think their cryptocurrency is properly secured, some traders choose to invest in a crypto wallet to hold their coins offline, so they're inaccessible to hackers or others. Other ways to invest in cryptocurrency. While investing directly in cryptocurrency may be the most popular way to do so, traders have other ways to get into the crypto game, some more directly than others. These include crypto futures. Futures are another way to wager on the price swings in Bitcoin, and futures allow you to use the power of leverage to generate massive returns or losses. Futures are a fast-moving market and exacerbate the already volatile moods in crypto. Crypto funds. A few crypto funds, such as the Grayscale Bitcoin Trust, also exist that allow you to wager on the price swings in Bitcoin, Ethereum, as well as a few other altcoins, so they can be an easy way to buy crypto through a fund-like product. Crypto exchange or broker stocks. Buying stock in a company that's poised to profit on the rise of cryptocurrency, regardless of the winner, could be an interesting option too. And that's the potential in an exchange such as Coinbase or a broker, such as Robinhood, which derives a huge chunk of its revenues from crypto trading. Blockchain ETFs. A blockchain ETF allows you to invest in the companies that may profit from the emergence of blockchain technology. The top blockchain ETFs give you exposure to some of the key publicly traded companies in the space. But it's important to note that these companies often do much more than crypto-related business, meaning your exposure to cryptocurrency is diluted, reducing your potential upside and downside. Each of these methods varies in its riskiness and exposure to cryptocurrency, so you'll want to understand exactly what you're buying and whether it fits your needs. Everyone gets into the cryptocurrency field to make money, but not all end up doing that. A lot of people either simply give up along the way or lose money because they do not properly understand how to make money with cryptocurrency. The cryptocurrency industry is still in its early stages of development. As the crypto assets increase in price, more people come into the industry. These newcomers are always trying to figure out how to make money from cryptocurrency. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.